This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
The first year of your retirement can make or break your plan due to a risk that very few people, it seems, they have awareness of. So a lot of us think that retirement success, it comes down to what the market returns on average, but actually when the market moves can actually matter more than how much it moves. And a market downturn in the first year of retirement, it can create lasting damage, even if the markets recover later. So Abe, let's break this down. First of all, what is sequence of returns risk and why is it something retirees need to understand?
Sequence of returns risk, Heather, is a risk to any retiree that when the stock market is down, the markets are falling, values are negative, the S&P and the indexes are down, that a retiree is also withdrawing money from their nest egg at the same time. And it's really, really important in that first year to maybe handful of years into retirement. You've just retired, you've just gotten to your pot of money, you've just started to take money out, and now the markets are down at the same time. Yeah. Double whammy, double negatives, values go down further, and it can be a big deal on your life savings going forward.
All right, so why is the first year of retirement then considered this danger zone for a lot of investors?
Yeah, and I would add to that, not just the first year, but probably that first 3 to 7 years of withdrawals, right? Like you're retired at 62, 65. For that first 3 to 7 years that you're taking money out of your life savings and nest egg, you've never done this before. If the markets are down all of those years, or a big year like 2008, or a couple years in a row like the tech bubble, and you don't have a safe haven, you don't have a safe pile of cash or investments you can go to that haven't lost money, and the markets are down, let's just say you're down 10 to 15%, and you're also taking 4 or 5% on top of that, you might be down 15 or 20 year after year after year, like what happened in the tech bubble for anyone retired then. And just think about the hole you've created that you now have to dig out of, and you may not be able to dig out of that.
But the market, we talk about all the time, how in the long run, there are ups and downs, yes, but the market recovers. So why does this early crash create all this chaos and for some people permanent damage?
Right. It's because the hole is deep starting off, right? Okay. If you start off in the green, if you start off retirement in the green, now you've got a runway. If you start off retirement in the red and you're taking 4 or 5% out of your nest egg, like a lot of people do, and you're losing and the values are going down, you've got double negatives, double losses. It makes it that much harder to dig out of that hole and get back up to even, or even get back up to a value that is higher than where you started. If you've got 5 to 7 years or 10 years, first 10 years of your retirement that are predominantly green, the runway looks a lot different. You should see it on paper, but it's real, and it's something you have to be aware of and to plan for.
So overall, what are these greater effects then as far as what happens when retirees are forced to take their withdrawals, even if the market's declining?
Yeah, a lot of retirement success depends on when the returns come. And if losses come early in retirement and you don't have a plan to eliminate or substantially reduce sequence risk, again, this is why a 60-40 to a 70-30 portfolio for a retiree is so common, right? It's because, well, I've got my $5 million or my $3 million. I'm going to allocate 30 to 40% of it that's very safe, protected, maybe no loss. On this side, I've got my growth and my equities. Well, that'll take a hit when the markets are down. This side won't take a hit. I can withdraw from the safe side. And that's absolutely crucial to have that combination of both potential growth and protection at the same time for a retiree. Otherwise, you might have to go back to work, or you could be dealing with less income, right? Let's say if you started with $1 million, you're down to 800,000 or 900,000. 4% from a lesser value is less income than if you had your full amount of principal or more in early retirement.
What about the emotion of it all, the fear in those early years of retirement? How can that all compound making the market losses even worse?
It can make things way worse, right? If you're watching the news all the time and you don't have a plan and you're putting emotions kind of in front of your decision making, or they're at the forefront of your decision making, which they really shouldn't be, but it's hard for them not to be when you don't have a plan, right? If you don't have a plan, then you can certainly be acting with emotion. And so when we put together plans, we try to eliminate or reduce emotions from that decision making and use methods, strategies, right? Methodical, mathematical decisions, plan-based decisions looking at the forest, not the trees, looking long-term, not short-term, not reacting to market cycles and news cycles, but looking at a long-term plan. And again, that combination of protected growth and income, risk and safety together for a retiree is crucial.
All right. All of this said, if you could tell a person listening to this podcast, watching this YouTube video, if they walk away remembering just one thing about sequence of returns risk, what do you want that to be?
Have a plan to eliminate or substantially reduce sequence risk at the point of retirement. And if you don't, and everything you have is fully invested, for a lot of people it is at the point of retirement because they haven't put together a plan yet. It's predominantly stocks and bonds. If you've got nothing safe in there, you don't have cash or treasuries or annuities or notes or whatever it is, something safe in there you can get your hands on to get income from when the markets are down and volatile, you could potentially have a big problem on your hands. And retirement outcomes and success and values down the road could look much different 10, 15, 20 years from now, as opposed to having a plan to defend yourself and your plan against sequence risk. It's real. We see it day in and day out. Don't take that chance, especially if you're at the point of retirement and you have the money saved, which is so often the case with people we meet, Heather. It's like, I mean, lately we're saying it to almost everyone we meet with. You've won the game. You can control your plan from here on out, right? You can put protections all around this if you want. You can control it. You can be proactive. Let's do it. Don't look back. Don't put this to chance that we're going to lose 20, 30, 40% and then have to withdraw from it and not have a safe bucket of money to go to. That would kind of be silly. So putting together a plan at the point of retirement, defending against sequence risk, very, very important. And that would be my encouragement for anybody watching.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abish Financial Services, visit theretirementkey.com and join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m. Abish Financial Wealth Management is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. The information contained in this material is intended to provide general information about Abish Financial Wealth Management and its services. It is not intended to offer investment advice. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Information regarding investment products and services are provided solely to read about our investment philosophy and our strategies.